why co-living and rooming houses are Australia's next big property investment. Hello and welcome. Today we explore smart strategies for building wealth through property. We're diving into a rising star in the Australian real estate market, co-living and rooming house investments. If you're looking for high rental income, solid capital growth and a hedge against rising property prices, this episode is for you. What are co-living and rooming houses? Co-living properties, also known as rooming houses, are essentially residential properties rented out by the room. These might be purpose-built or converted homes where each tenant rents a private room and shares common facilities like kitchens, living spaces or bathrooms. They're particularly attractive in areas with strong rental demand. Think students, young professionals or people seeking affordable housing close to cities. Why they're so profitable? Let's talk numbers. A traditional investment property might bring in $600 to $800 per week in rent, but a 5-bedroom rooming house can generate between $1,500 and $2,000 per week. That's double or even triple the income, and in some cases it means gross rental yields of 10 to 13% compared to the 3 to 5% you get from a standard house. That's huge, especially for investors focused on cash flow. Capital growth, the cherry on top. Now, high yield is great, but capital growth still matters. The good news is co-living properties usually sit on standard residential land. That means you're not missing out on appreciation. In fact, if you invest in the right suburb, say outer metro areas like Logan in Queensland or Melton in Victoria, you could be looking at 5 to 7% annual capital growth on top of your cash flow. And if zoning or renovations increase the property's value, that's icing on the cake. Why demand keeps growing? Let's face it, Australia has a housing affordability crisis. Rents are rising, home ownership is out of reach for many, and we're not building fast enough to keep up with population growth. Co-living fills a critical gap, providing affordable, private accommodation in areas close to work and transport. Government rent assistance often supports these tenants, and the waiting lists for these kinds of rentals can be long. So vacancy, not usually a problem. Case study snapshot. Here's a quick case study. A client bought a rooming house in Logan for $700,000. After minor renovations and getting council compliance sorted, it's now renting for $1,850 per week. That's nearly $96,000 per year in rental income. Even if the property grows just 6% annually, that's an added $42,000+ in equity each year. Powerful combination. But what about the risks? Of course, no investment is risk-free. Management can be more involved. You'll want a specialist property manager. You'll need council approval to run a legal rooming house. Tenant quality varies, so screening is essential. But the risks are manageable, especially when weighed against the income potential. Exit strategies. Worried about resale? Don't be. You can sell to another investor at a premium yield, or even convert the house back to a single dwelling if needed. Some investors build with flexibility in mind, so you always have options. Final thoughts. If you're a cash flow driven investor or looking to diversify beyond traditional houses and apartments, co-living could be the game changer. It's not just about riding the property wave, it's about creating income now while still building wealth for the future.